I'm Chantel Leeson, and welcome back. My special guest today is Stuart Kruse. He's a certified financial analyst and CEO for Kruse Asset Management. Stuart, how are you today?
I'm doing great. How are you doing today?
Wonderful. Thank you for joining us today. I'm looking forward to hearing your conversation.
It's my pleasure. Thanks for having me.
You're quite welcome. What's your subject we want to talk about today?
Well, I'm going to talk about something that I don't think a lot of retail investors know about, and it's an asset class called structured products. And they've been a little bit, I'll say, kind of put on the back burner for a while, but there's a very popular Chicago company that's kind of turning that around and making structured products more accessible to the everyday person. A structured product is, what the name would be implied, is a structured income that has an underlying investment. So for example, it's a CD or a bond that instead of you paying interest like you would get at the bank, it pays you based off of an underlying asset, which could be an index like the S&P 500. It could be gold. It could be a basket of stocks. It could be anything you want. It's structured to give you a particular payout. So for example, a very bare bones basic structured product might be something that is principally protected. So in order to walk you through this, like a CD, it will have a maturity. And let's just say the structured product is a 5-year maturity. And if you were to go to a bank and get a CD, maybe you'd get a couple percent for that CD. But if this structured product was linked to the S&P 500 and it were principally protected, what happens is in 5 years, you look at how the S&P has done. If the S&P is up, you get the returns of the S&P, or sometimes actually even a little bit more. If the S&P is down, which it's down about 20% of the time in any 5-year window, your principal is protected, so you get your money back. So it's a way to participate in the upside of the market and not take any risk. It's a very bare bones basic version. Now, a structured product term is a catch-all for all sorts of different structures. So that one was principally protected. You could have things with just some protection, maybe 10, 15, 20% protection to the downside. You can actually have capped upsides, but accelerated returns. They get all sorts of complicated. So you generally, the reason why they weren't very popular or haven't been very popular in the retail market is because they're hard to analyze sometimes. They get to be complicated. And frankly, a lot of retail advisors don't either have the patience or the tools to analyze these structured products. But it's a $4 trillion marketplace. They're mostly used by institutional level investors who have the capabilities and the technologies to analyze these products. Now, Kruse Asset Management, we're a quantitative investment firm, so we're comfortable with the analytics. But we've partnered with a company called Halo Investments, which is out of Chicago, and their goal and their mission is to democratize structured products for the retail investor. So we can create our own structured products on the fly using artificial intelligence and bid them out to the banks. So it's a great asset class to help reduce risk for people that maybe don't want the risk, but also want the upside reward.
I was going to ask a question here. Would you say sort of comparable to the index product?
You mean like an index variable annuity?
Yeah, index annuity or index, any kind of index product.
Yeah, so typically an index annuity or some sort of index product will give you a lesser version of that return. So for example, if it's indexed to the S&P 500, you might get a percentage, 60%, 80%, 50% of that S&P. For structured products, you usually get actually a leveraged upside. So for example, we just created a product that we put all our clients in that had 30% downside protection. Now, keep in mind, the S&P in a 5-year window has only been down one time more than 30% over the last 50 years. So the odds of this negative occurrence happening are really small, but on the upside, you had leverage return of 118%. So you actually got a greater upside return than you would had you just invested in the S&P, where these index products tend to be indexed and get you a fraction of the return, half of that return.
Wow, that's a big difference.
Huge difference, and compound it. And so compounded over your life, what you want to do is you want to take calculated bets. Like if you said, I wanted to put $100,000 to work, I wouldn't suggest you taking $100,000 and putting it all in one structured product we create. you would want to ladder those in with the odds in your favor. So 10,000, 10,000, 10,000 perhaps. So it's a little bit like going to Las Vegas and saying, hey, I am the house. Does the house want to play just one hand, or does it want to play a bunch of hands with the odds in its favor? Well, it wants to play a bunch of hands with the odds in its favor because it can lose any one hand. But if you have the odds on your side, the more hands you play, the more of a mathematical certainty it is that you're going to win.
Exactly. Yes. Yes. What it sounds like is it's not as risky as it appears, though. Well,
yeah, I mean, that's the whole point of these structured products is they are there to eliminate or reduce the risk. And as you ladder them in, you're further reducing more and more risk. So they become a little more complex to analyze. But again, with the help of Halo and some other analytical companies, they're becoming much more easy to access and understand. So for example, as I said, you can structure any product you want. We created an income note recently. Whether you like this or not, this is just an example of what we can do. We created an income note with the underlying is Tesla stock, which sounds extremely risky for some of my clients. And I wouldn't buy Tesla stock for a lot of my clients because of the volatility. I'm not saying anything about Tesla as a company, just the stock volatility is not appropriate for everybody. But this income note, it's an income note and it's predicated on paying interest as long as Tesla stock has not dropped by 50% from the point of its strike price. Now, I'm not saying Tesla can't drop by 50. It certainly could, but it has never, ever dropped by 50%. So I would say the odds are in your favor that it won't drop by 50% in this one print. And in the meantime, for as long as Tesla has not dropped by 50%, if it dropped 30, 40, 28, went up 20%, our clients get a 20% annualized return, a coupon of 1.66% paid every single month. So maybe that bet's good for you, maybe it's not, but it's a way to reduce risk, take an income in a very low interest rate environment, and place bets on companies and stocks that you think are solid, but that, and through the analytics, you can look at to see whether these things have occurred or how often they have occurred. And in Tesla case, it's never occurred. So that's a small bet I might want to take for some of my clients to earn 20% on their money.
20% is a marvelous return of money.
Yeah.
Not only that, but having to know that it's not as risky as it appears.
Right. Exactly right.
With most retail investors, retail and financial advisors, they don't understand that.
Quite often most retail advisors will outsource the money management part. And so they don't really have as much incentive and or interest to basically do the analytics. They will use ETFs or mutual funds, and they might put together some asset allocation plan, but the actual analysis part is usually not their forte. They're into the relationships, which is great. And you have to have a great, solid, trusting relationship with your advisor. But a lot of advisors will farm that part out. And so some will, take the time and to analyze some of these structures that are available to them, then they can add value to their clients.
I think that probably more of the independent financial advisors are more open and receptive.
Yeah.
I think more that are in a house, the house advisors for the big wirehouses, maybe not be as open.
It might not even be because the advisor themselves are not open. It may be because of their compliance department wouldn't allow them to be open. So for example, a very large firm here in Chicago, William Blair, this is my understanding that William Blair all their advisors were not allowed to use structured products at all because of the difficulty in advising clients on these structured products. And so if you think it from a compliance standpoint, they have to make sure all of their advisors have the tools and capabilities to be able to analyze these products so that they can protect all of their clients. And so they just made a blanket statement that you just can't use them. Now, since then, this is again a commercial for Halo Investments here in Chicago. Halo has partnered up with William Blair, and because of their analytical tools, they're now allowing those advisors to use structured products. But this is just one example of a capability of a larger bank just making a whole, across the board decision saying you're just not allowed to use them at all because of a compliance reason.
Wow. I like the idea of having Halo.
Yeah, it's great. I mean, I will tell you, I would buy, let's say, a JP Morgan structure. And by the way, people have never heard of these things, but JP Morgan, Citibank, Goldman Sachs, Bank of America, they've been offering these structured products every single month for as long as I've been in business, and that's been well over several decades. Okay?
Yeah.
So they are out there for sure. It's not, these are not a new product at all. But let's say if I were to buy a JP Morgan product directly from JP Morgan,
Right.
I actually have to write a letter to my bond desk in order to get this transacted. And now Halo has made it so that I can go on their platform and just order it online, more or less. Very similar to how Amazon makes purchases more easy for everything else. So like when I want to go buy a volleyball, I don't go to Dick's Sporting Goods because it's too much of a hassle. I just order it from Amazon. It's the same thing for structured products now. Instead of me going directly to JP Morgan to get my structured products or Bank of America or Citibank, I go through Halo platform and they will give me the analytics and tools and give me the best price for my clients. So it's very cool.
From a client perspective, what would be the ideal client for this product? Is it retail clients in a retirement account, or give me some idea who we'd be looking at?
So I initially started using these clients for extremely risk-averse people because I had a set of clients that said, I don't want any equity at all, no equity exposure whatsoever. And the reality is if I have a 100% bond portfolio, that portfolio itself has more risk in it than a portfolio that does have equity in it.
Yes, it is.
There's prize-winning papers that basically suggest, Nobel Prize-winning papers that suggest that about a 20 to 80% equity to bond ratio is the lowest risk profile because of potentially loss in purchasing power. But trying to convince a client of some Nobel Prize-winning economic data and what their intuition says are two different things. But if I can come to them and say, I have this structured product that gives you equity exposure with no risk, you might lose potential income of 1%, but with the possible gain of 10% a year, would you be willing to take that risk? And they're like, well, as long as I'm not losing money, I'll take that risk. And then I can give them the 20% equity exposure that they so desperately need to keep them up with their purchasing power. So that's where I started with this. But then as you started looking deeper and deeper into some of these structured products, we have kind of decided across the board, at least our firm, to allocate at least 10 to 20% of our clients' portfolios to structured products, because some are extremely risk averse, and there are some that can be a little bit more risky, like perhaps the Tesla product, which will still give you 20% returns, but you have some dependence on a more volatile stock. Mm-hmm. So we're treating it almost as another asset class because the correlations are very low to the S&P 500, and the volatility tends to be low. So it actually reduces your risk of a client's portfolio. So who could use it? Really, anybody can use it as long as they can get their head around the analytics and get comfortable with it. You want to be comfortable with the investment.
That's a good statement. Let me ask this question then. What would be the bottom dollar to get into a product like that? And the reason I asked this question is because I know there are other financial advisors listening, and I did used to work for JP Morgan, so you're talking about my own firm. But there are people that don't work for firms like JP Morgan. They work for firms where they don't understand a structured product and don't have the exposure to it, but may have the potential if their compliance officer can get their head around it. What would we be at?
So the minimums are $1,000. You can buy one structured note for $1,000. Now, generally you have to go what's called on calendar, which means JP Morgan, Citibank, Goldman will put out a list of structured notes, and there'll be dozens of them that they'll put out every month. And they'll say, these are what we're offering. Because it costs money to put these things together every single month. They'll say, these are what we're offering, but you can buy in $1,000 increments. Now, we created the Tesla note and we created that other S&P note, in which case we would need probably somewhere in the neighborhood of $200,000 to create a note for our particular clients on the fly, depending on market conditions. But to get $200,000 worth of exposure across all our clients is not that hard. So if you're a retail investor and you actually have a JP Morgan or Chase bank account, it's quite likely that their local representative in the bank won't be able to sell you those products. They're more institutional level. So you might actually have to go through an advisor to get them.
Okay, very good. So you need more than one financial advisor then to do that. I just want to know that, because your diversification in your portfolio is not limited to just the advisor. You need to look beyond that.
Right. I mean, it's been said, not certainly by me, by smarter people than me, but Nobody has a market cornered on great ideas, right? So a lot of my clients will have 1, 2, 3 guys, and we all have different access and exposure to different ideas. And, they are the ones that are the CEO of their financial fortune, and we're their CFOs or their advisors. So we bring them ideas. Some of my clients for sure hand me over all of their money, but some of them like to have, diversification in the advisory board as well. So
what's important in anybody's portfolio. And let me clarify another thing. So this would be comparable to, because you didn't say what specific asset class it fits in. Would it fit? And that's the hard part to define. Am I correct in saying that?
So they are kind of a hybrid between a bond and an equity. And it depends, quite honestly, what the underlying structure is, because I could create a structured product linked to the gold index. So in which case it would be a commodity or a precious metal, or I could link it to the 10-year treasury if I wanted to. So, but let's just assume we're going to link it to stocks. The underlying structure of a structured product is usually created with a bond, a fixed income instrument. So it acts like a bond in the very, very beginning. And then as it gets closer and closer to maturity, it's going to act a lot more like that underlying security, be it the S&P 500, be it a basket of stocks like the bank stocks, or whatever you linked it to. So it's going to act a lot more like an equity. So in between that, it's going to be a hybrid. And some would say that there's a big gap between what bonds will do in very low interest rate environments and sometimes very low risk, and what equities will do, where you have a lot more volatility, but a lot more return. And a structured product would probably fit kind of in the middle of those things.
So a structured product can fit into an IRA account if the company allows it.
Yeah, absolutely, 100%.
Is it a good product to put into a trust account? You've got a young baby and you want to put something aside for college. Would that be a good product to put into a trust account?
So I love them in accounts that, because they tend to have maturities, and the ones that tend to work longer are better are the longer ones of 5 years. So they are much better off in a set it and forget it account. Now, again, if you had it in a younger trust account and you had, let's say, $50,000 put away, I wouldn't necessarily buy $50,000 in this one product. I might buy a 5-5-5-5 and ladder it out, or 10-10-10-10, so that, because you're depending on a point-to-point outcome, right? So if the S&P does well in this one note, you're going to do great. But what you're trying to do is take advantage of the averages, right? So in one 5-year window, the S&P could be down, or it could be up. But if you ladder it out, again, you're going to get an average return more like the S&P 500, and it's going to be much more predictable for you. So if you had it in a trust or an IRA or these accounts that you're not supposed to touch for a long period of time, you ladder them in over time, you reduce your risk, and you make your returns much more predictable.
From a historical perspective, how have they performed over the past, let's say, 25 years? Or let's go back to the last really bad market. How have these performed?
Well, because the underlying is based off of an index that we created, it depends on the structured product, right? But let me put something into, I'll give you an example. There was a structured product that we used that was based off the lesser than. So the worst index you could have between the S&P, the Dow, and the Russell. So 2 large cap indexes and small cap index. And you got the worst performer. And you would say, why would I want the worst performer? Well, if the worst performer was positive, you got a leveraged upside of 1.4 times that number. So in 5 years, if it was up 40%, your return was 56%. If it was up 50%, your return would be 70%. On the other hand, if that worst performer was negative, you got the positive version or the absolute value version of that return. So if the worst performer was down 20%, you got a positive 20% return.
Wow.
Sounds awesome. Now, that goes to a point of down -30. And if it was down -30, you would get a positive 30%. But if it was down any more than that, 30.001, you got the full loss, just as if you had invested in the index. So again, going through the math and looking over the last 50 years, that happened one time. So the odds of having a positive outperformance was literally 99.8% with a 0.2% chance of a loss. The worst loss would have been down 36%, but the expected value was that you would outperform your index 70% of the time, and that your average return was about it was going from memory, but about 11% versus 9% for the S&P. So very low risk of loss. Average expected return higher per year. Much greater chance of positive outcome, but that only works really if you ladder them in over time. So when you ask me how did they do well, those dual directional notes did awesome. If I looked at the ones that were only 2 years out, they did horrible. Their average returns were in the 3 and 4%. So it really depends upon the underlying. But kind of a question which I will ask for you is, where's the risk? Because these notes, in theory, take on the risk of the issuing bank. So if JP Morgan issues the note, you, in theory, take on the credit risk of JP Morgan. So what I would argue is that given what we just went through with the COVID lockdown and what we went through in the financial crisis, where the banks were too big to fail and the banks were bailed out every step of the way, that there is almost no risk. I can certainly not say there's no risk, but the Fed has set up a precedent that they will not let these large banks go out of business, so that the marketplace will have a smooth and operating financial, financial system, right?
Exactly.
There was one bank in the financial crisis that I worked for that went out of business. That was Lehman Brothers. Everything else was purchased. So Lehman Brothers was actually allowed to go bankrupt. So if you had a structured product issued by Lehman Brothers, in theory, you took on their credit risk. And if Lehman Brothers went out of business, in theory, so should have that structured product. But all of those dollars were paid and made good. So in the only example of a big bank going out of business, in which case they could have lost money, all of the notes were paid because Barclays came in and bought Lehman Brothers, bought all the assets. Everything was money good. So I'm not aware of a large bank having ever defaulted on a structured product in the last several decades. So I would say this is pretty well guaranteed and backed.
You know what this says for the average investor, because that's what we worry about risk.
For sure.
You've clearly defined that they've minimized that risk, or in some cases even eliminate the risk.
Right.
And I think what's happening is that when you're talking about retail advisors, they don't even recognize that it's not as risky as it appears to be.
Right.
That's the biggest fierce risk. And I think that the compliance officers who approve whether a product can be bought or sold within the house, that's what it is. They don't understand them.
That's usually the case. If you don't understand it, then they just say, no, we're just not gonna, we'll just take away all the problems. We just, no, you can't use this. So
it also minimizes what happens to the client's portfolio over the long term.
Right.
As part of the asset, you're doing asset allocation, you're looking at something that's going to give a client a little more upside potential and less downside risk. That's what you're looking at, something like a structured product.
100%. 100%. Now I'm it's a little self-dealing here because I'm an independent advisor, but I would recommend, if you're going to be buying these things, to go through somebody that's more independent, because if you're going to a JP Morgan or Goldman, they're going to suggest that you buy their product, right?
Exactly.
And of course, nobody has the market cornered on the best. JP Morgan, I buy a lot of those particular kinds of notes, and they're very good at, I would say, the dual directional notes, but maybe not so good at the principally protected notes, right? And so you want to find the best option available. So that's why you probably want to go through an independent advisor.
Wow. Stuart, you've covered a lot of information today. What I'd like to know, how can someone reach out, and I'll help you put in the chat box, what's the best way for people listening on the our presentation here? How can they reach out to you?
Our website is kruseassetmanagement.com. That's Kruse, the word assetmanagement.com. You can reach out to me at Stuart@kruseassetmanagement.com, or on LinkedIn, which is at KruseAM. So LinkedIn.com, IN, KruseAM.
Now, do you work with other financial advisors who are looking to leverage? And the reason I ask this question, sometimes financial advisors recommend someone, and they're not, this is what when they're not selling out the house or not selling, they look for someone else who can help a client, because the clients are asking for something they can't sell. Do you reach out with their financial advisors in that way?
Sure, we work on a team-based model. We have products that we've been running for 15 years. We have some very quantitative-based strategies that I use with other financial advisors. I've used some of their products as well. I collaborate with As I said, on a team-based model, I generally don't sell insurance or annuities or whatnot, but I have teams of experts that I work on it, with them as well. So yes, I'm happy to talk to anybody about how we could collaborate.
Wonderful. Yeah, before we wrap up, we got about 2 minutes left. What else do you think people out in the public here want to hear about your company and the products you're offering? Or at least about structured products?
Yeah, it's all about structured products. We've been also doing a lot of things and giving access, in addition to structured products, to like venture capital and private equity. So those minimums are coming down, and when you get closer and more access, and working with some other higher level groups, we've been able to provide access to some of our clients and non-clients to some amazing private equity deals recently. So that really helps the risk reward profile of our retail investors. Ties up the money a little bit, but long term, again, it really helps out with the risk adjusted returns.
Well, Stuart, before we wrap up here, one other thing. I don't want this to be a one-time. Can we get you back in the future?
Absolutely. I'd love to see you again.
Wonderful. This has been great talking to you, and I'm very happy with our discussion today. I think our public's learned a lot.
Good. Glad we could help.
I look forward to seeing you again.
Okay, take care.
Bye now.